This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Office raid. Federal agents search Caterpillar's headquarters and shares of the Dow component tumble.
Snap and Pop, a messaging app that was once written off, is now worth about $35 billion, and there are a few reasons why investors scooped up the shares.
A seller's market. Why timing is everything for the fastest home sale at the highest price. Those stories and more tonight on Nightly Business Report for Thursday, March 2nd. Good evening, everybody. I'm Sue Herrera.
And I'm Bill Griffith in tonight once again for Tyler Matheson, who is on assignment right now. A rather unpleasant surprise for shareholders of Caterpillar today. Shares of the Dow component and global industrial conglomerate suffered their biggest decline in 8 months after law enforcement officials raided 3 of the company's facilities, including its headquarters in Peoria, Illinois. Certainly something that no shareholder wants to hear about. In response, the stock fell more than 4% today, making it the worst performing member of the blue chip Dow index. Morgan Brennan tells us right now what we know at this point about today's raid.
It's a knock on the door no company wants. Law enforcement officials searched 3 Caterpillar facilities today, including headquarters in Peoria. The U.S. Attorney's Office for the Central District of Illinois confirmed the searches and said agents from the Internal Revenue Service, the Federal Deposit Insurance Corporation, and the Commerce Department were all involved. Caterpillar is cooperating with authorities and said, quote, while the warrant is broadly drafted, we believe the execution of this search warrant is regarding, among other things, export filings that relate to the Swiss subsidiary. The matter first disclosed in Caterpillar's Form 10-K filed on February 17, 2015, and updated in the most recent Form 10-K filed with the SEC on February 15, 2017. The Caterpillar is referring to investigation into whether the company tried to evade paying more than $2 billion in taxes by using a Swiss subsidiary to sell replacement parts that came from U.S. operations. Even with this previous disclosure, investors did not seem to like the pictures of federal agents swarming Caterpillar facilities, in an apparent signal that the situation could be escalating. For Nightly Business Report, I'm Morgan Brennan.
That decline in Caterpillar shares pressured the broader market, which pulled back from record levels. Materials stocks fell, along with energy companies and financials. The day closed like this. The Dow Jones Industrial Average fell 112 points to 21,002. The NASDAQ was off 42, and the S&P 500 lost 14.
And despite today's pullback, the stock market is still sitting near record highs. But are investors ignoring some caution signs like rising interest rates or weaker economic growth? Steve Leisman takes a look for us.
Like a great running back, the stock market has sprinted from 20,000 past 21,000 with explosive speed. But it's also done so with considerable strength, dragging defenders along the way. The yards have come while stocks have battled the chance of a faster rate hike from the Fed and a stronger dollar. That chance of a Fed rate hike in March has more than doubled in just the past couple days, and the market has increasingly priced in a 3rd rate hike this year. Fed Governor Jay Powell made clear that a March hike is a real possibility.
The economy has behaved pretty much as we expected. In the meantime, the balance of risks, which has been to the downside in recent years, has really shifted to being even and perhaps lifted to the upside because of the possibility and indeed likelihood of some fiscal action. So you put all that together, and I think the case for a rate increase in March has come together, and I do think it's on the table for discussion.
Stocks seem to believe in a solid economic underpinning. Wednesday's 300-plus point rally ignored weaker economic data. Powell suggests the U.S. could finally be getting help from abroad.
For the last few years, we've really had significant global risks and weak growth abroad. And I think that the risks have diminished, and actually, growth in Europe is a little stronger, inflation's a little higher. Same is true in Japan. So we see a slightly brighter picture abroad, and that I think that will help us.
It seems as likely that what's driving investors is the promise of tax cuts, infrastructure spending, and deregulation from the Trump administration, all of which seem more likely after Tuesday night's speech by the president to Congress. How the Fed will react could become more clear with speeches on Friday by Fed Vice Chair Stanley Fischer and Chair Janet Yellen. They're the two most important players on the Fed team. For Nightly Business Report, I'm Steve Leisman.
So as Steve just laid out, there are many factors driving the market right now. So let's turn to our two market pros, a bull and a bit of a bear, so to speak, for their thoughts on where the market might go from here. Mike Jones is the Chief Investment Officer at Riverfront Investment Groups. He's a bit cautious on the market. And John Stoltzfus is the Chief Investment Strategist at Oppenheimer Asset Management, one of the most bullish analysts on Wall Street. Welcome to both of you. Appreciate it.
Thank you, Sue.
Glad to be here.
John, let me start with you. We've had an enormous rally in this market, specifically since the election. Why do you think that there's significantly more room to run in this market?
Well, Sue, I really have to say the fundamentals are good. The economic expansion in the U.S. continues to look sustainable, and even more so on a month-to-month basis when you look at the economic data. Plus, we've just had fourth quarter reporting for the S&P 500, that on back of a third quarter that was also positive, both in terms of revenues and sales in the fourth quarter. We've got to say fundamentals intact. If anything, also the run-up that we've seen since the end of last year through February was only around 5.3% on the Dow, 5.7% on the S&P. Very different than 1987, which a lot of people mentioned, where both the Dow and the S&P were up 17% apiece in that short period.
Mike, you're not alone in being cautious on this market. Some very respected names on Wall Street, Jack Bogle, for one, are also cautious right now on valuations and things. My question to you is, what do you think the catalyst will be to break this fever, this rally we've seen since the since the beginning of the year with the post-election period here? What is your biggest fear right now?
I think my biggest fear, I agree 100% with John, that we've had great earnings and that the economic support for future earnings growth is really solid. But, you know, even with very importantly stronger earnings expected, that's still putting us at 20 times higher earnings expectations. And I think, as we saw yesterday, the real thing that's driving this market right now is less the fact that earnings are growing and more that we're expecting good things from the Trump administration, and we're expecting them right now. Now, I do believe that the Republican Congress and President Trump are going to agree on tax reform. We're going to get infrastructure spending, but we're not going to get it anytime soon. They're going to tackle health care first. Tax reform isn't even on the agenda until the summer. Infrastructure spending isn't until the fall. That means that all those goodies that Trump talked about, in his speech, we're going to have to wait till 2018 earnings to see those reflected in company results. And at 20 times earnings and rising interest rates, that just says to us the market's a little frothy here.
Yeah, John, what about that? Because there are other people who agree with what Mike's saying this market is priced to perfection based on the assumption that the Trump administration will be able to achieve almost 100% of its agenda and do it quickly.
Sue, when it comes to our thinking on this, we'd have to say our target for the S&P 500 for 2016 was 2,300. It was realized by the market 1 month and 9 days later this year. It came through in early February. That said, we think the Trump election has been a good tailwind for the market. But again, we think it's fundamentals. And in terms of multiples, the average PE multiple of the S&P 500, average 12-month trailing PE, all the way back to the end of 1965 is 16.3 times. So at 21 trailing right now, that would seem high. But the average yield on the 10-year Treasury since 1965 is 6.4 to 6.6%. The current yield on the 10-year Treasury, last I looked, was about 2.45%.
So, Mike, does this mean you're not buying anything right now? Are you looking to pick up some bargains at some point? What are you doing right now?
Well, we put a lot of money to work right after the day after President Trump was elected. We've taken about half of that incremental money out of the market, and I'll be honest, we're looking for an opportunity to take the other half out. We think the market's gone a little too far, a little too fast. We agree with the fundamental underpinnings for this rally, but we think that optimism's gotten a little ahead of itself. So right now we're looking for an opportunity to lighten up. The only thing that makes me think we may not see a pullback, we may just see the market chop sideways for a while, is there have been a lot of people who have missed this rally. There are a lot of frustrated people with cash on the sidelines. They're waiting for a pullback. That may mean we just get a long period of consolidation rather than a sharp pullback.
All right, John, you get the final word. I've got a little less than 30 seconds. Kind of plain vanilla, if you will, where would you be putting your money right now?
Right now, we would be diversifying broadly. We would look for opportunities on a global basis, including emerging markets and developed markets. But we're still overweight the U.S., and we'd be looking at adding to small and mid caps, which have actually underperformed the large caps so far this year.
Okay.
We think they'll do better going forward.
Gentlemen, thank you both. Appreciate it. Mike
Thanks,
Jones
Sue.
with Riverfront Investment Group and John Stolfus with Oppenheimer Asset Management.
Certainly a lot of action today at the New York Stock Exchange, where shares of Snap, the parent company of the popular messaging app Snapchat, made its Wall Street debut. And on the first day of trading, the stock soared by 44%. Bob Pisani has more on the biggest IPO since Alibaba.
Snap certainly popped today. Remember, the company priced at $17 per share, but then it opened at $24, closed at $24.48. That's a successful opening. A 44% pop, giving the company a market capitalization of about $34 billion. Oh, that's big league. It's in the same neighborhood as big names like Travelers or Deere, General Mills, even Marriott. So why the healthy pop today? Well, there were several reasons for it. First, the markets are trading near historic highs. Remember, we just saw the Dow, the S&P, and the NASDAQ all hitting new records and having their best day of trading in 2017 just yesterday. That's a recipe for higher valuations. And a strong market is generally a necessary, but it's not a sufficient factor. You need other things to happen. Second, investors have been starved for a hot, high-demand IPO for a long, long time. We haven't seen an IPO this big since Alibaba back in 2014. And Snap, it's a household name. Everybody knows Snapchat. And the millennials have embraced it. They really do understand how it works. And finally, the number of shares in the company that's been floated is relatively small. It's just about 14% of the total shares outstanding. So there's not a lot of supply out there, and that tends to drive up investor appetite for the stock. A lot of tech companies do this. They float 10 to 15% of the shares. So now the question becomes, can Snap finally put the pep back in the IPO market's step? Well, it's not quite clear yet. It's still early, but my bet is we'll see things start to pick up as soon as this spring. That's the middle of April. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The Snap IPO was a big topic of discussion at the YPO Edge conference, made up of thousands of professionals from all across the globe. Tyler Mathisen was there and asked the executive chairman of Cisco about Snap and whether it's the type of company that reflects the transition from the internet age to the digital age.
To the first of what will occur over this next 2 decades. But I have seen the movie before. This is like 1990 to 2010, the internet era. And during the 90s, and using Cisco as an example, we grew at 65% a year. So the key is you've got to capture these transitions, and they run for a long time. Some companies do very well, some have setbacks.
Mr. Chambers also said that regulatory changes are needed in this country to support startups and that the country needs 5 times as many startups going public to meet economic growth targets.
Still ahead, why Americans are borrowing more than ever to buy a vehicle.
The number of Americans filing for unemployment benefits last week fell to a near 44-year low. Jobless claims dropped 19,000 to 223,000, pointing to a further tightening of the labor market. Some experts say labor market tightness combined with rising inflation could prompt the Federal Reserve to raise interest rates.
The Consumer Financial Protection Bureau, born out of the financial crisis, is now at the center of the fight in Washington to roll back some of those regulations governing Wall Street. That expectation of getting rid of some of those rules is in part what propelled the stock market higher. John Harwood spoke to the man in charge of that agency, known as the Financial Consumer Watchdog. John, what did he tell you?
Well, Bill, Richard Cordray was appointed by Barack Obama, but Donald Trump's Washington is entirely different. I asked him about complaints from Republicans in business that he is an unaccountable regulator.
First of all, I think it's completely ill-founded. There's never specifics in those kinds of claims. But what I would say is accountability is really at the heart of this agency. We're all about holding financial companies, large financial companies, accountable for complying with the law and treating people fairly.
Doesn't accountability mean that somebody in government above you can fire you or change your budget?
Well, what they can do is replace you from time to time. That's the way the independent agencies work. Nobody's talking about firing Janet Yellen at the Federal Reserve. Nobody's talking about firing other independent agency heads. That's the principle of our government.
Replace you from time to time. Richard Cordray's term runs out in July 2018. The question is whether he'll make it that long.
Well, that's my question. I mean, having said all that, what do you think? Will he be fired?
Well, here's the question, Bill. There are a couple of options. One of them is to, if a legal case comes out in favor the way the Republicans want it to, President Trump could unilaterally fire him. Another way is for the Republicans to simply abolish the agency in a Dodd-Frank reform bill or reform of Dodd-Frank. A third way is to change the agency so it's a commission structure, not a singular regulator, and having Congress control the purse strings rather than have the money flow automatically from the Federal Reserve. The question is, with all the other fights going on in Donald Trump's Washington, do Republicans want to take this one on too? Elizabeth Warren would be a high-profile opponent, of course.
To your second point, John, there was a survey today that showed just 12% of Americans have a favorable view of that agency. So does it have an image problem, perhaps, as well as a political one?
For sure. And it's part of the government. Government itself, across the board, has a terrible image. The question is, if you engage a fight with Democrats saying, no, you're going to take away a consumer agency, Republicans saying we need to free up business, does that change how that opinion goes? We've seen what happened on Obamacare, which is that opinion has gotten more positive as Republicans have gotten closer to repealing it. That dynamic could repeat.
John Harwood for us in Washington tonight. Thanks, John.
You bet.
Adele helps put the brakes on sales at Barnes & Noble, and that's where we begin tonight's Market Focus. The bookstore chain said same-store sales in the fourth quarter fell more than 8%, citing weak demand for adult coloring books and sluggish foot traffic, but also a tough comparison to 2015, when it had strong sales from Adele's blockbuster album, 25. Profit also fell, with the company saying things aren't going to improve anytime soon. As a result, it cut its earnings and sales outlook for the full year. You put it all together, and Barnes & Noble shares fell more than 8% to $9.05. Abercrombie & Fitch said a challenging and competitive retail environment hurt quarterly results, causing it to miss estimates. The company also said it will close 60 stores, but the apparel chain still said it expects same-store sales to improve this year. That sent shares up about 14% to $13.32. And Kroger's earnings and the revenue beat street estimates, but the supermarket operator disappointed investors with an unexpected drop in same-store sales. The company cited food price deflation and said it expects the operating environment to remain challenging for the first half of the year. Kroger shares were off more than 4% to $30.67. E-Trade has joined the list of brokerage firms cutting trading fees. As we told you earlier this week, a growing number of discount brokers have lowered investor costs as they try to remain competitive. Today, E-Trade said it would slash trade commissions to $6.95. That's down from $9.99. Shares also dropped today, down 3% to $35.03.
Anheuser-Busch InBev said that weakness in its Brazilian market caused annual profits to fall for the first time ever. Brazil is the beer giant's largest market after the United States. The company also posted lower earnings in the latest quarter, while revenue edged up slightly. Bud shares down more than 3.5% today to $105.85. And specialty construction chemicals maker GCP Applied Technologies had a worse than expected profit and drop in sales. Still, shares rose following news that the German consumer goods company Henkel submitted a binding offer to take over one of GCP's businesses for more than $1 billion. Just GCP shares soared by 17% today to $31 a share. And late today, Costco said that it's raising its membership fees. That's its primary profit driver. The retailer hopes that the increase will offset higher costs. The fee increase is the first since 2011. It takes effect June 1st, affects 35 million members. The company also said that its same-store sales, by the way, missed estimates. And that sent shares down initially in after-hours trade. It closed the regular session with a slight gain.
If you're considering how much more it will cost you to buy a new car compared to a used one, here's something to keep in mind. On average, people taking out auto loans are borrowing at least $11,000 more for a new car than a used one. Not surprisingly, it's the reason why Americans are borrowing more than ever before to buy a vehicle. Phil LeBeau has more.
It is costing more than ever to buy a new car or truck. In fact, the average price paid in dealerships last month was almost $35,000. The jump in prices is due to the fact more people are buying pickups and SUVs, which typically cost more than cars. As a result, Experian says the average loan for a new vehicle is now at a record high of more than $30,000. Compare that with the average loan for a used car, which is also at a record high, but under $20,000. That's the largest gap ever between new and used auto loans. Because buyers are paying more, they're looking to stretch out the length of their auto loans. In fact, almost a third of all new vehicles come with loans stretching payments over more than 6 years. Is there a limit to how much higher prices can go at the dealership? If there is, we haven't seen it yet, which is why the U.S. remains the most lucrative auto market in the world for companies selling cars and trucks here. Phil LeBeau, Nightly Business Report, Chicago.
And to read more about the record gap between new and used car loans, you can head to our website, nbr.com. Coming up, thinking of listing your home? There are 2 weeks during the year where it may sell the fastest.
The Senate confirmed former Texas Governor Rick Perry as Secretary of Energy today. The vote was 62-37, including 11 Democrats who voted thumbs up. Governor Perry said during his confirmation hearing that he would pursue sound science as Energy Secretary, and he acknowledged that human activity contributes to climate change.
Retired neurosurgeon Ben Carson was also confirmed as Secretary of the Department of Housing and Urban Development. Support for Dr. Carson was primarily along party lines. Carson will be responsible for driving housing policy and will oversee programs that provide assistance to low-income Americans. Carson ran for the presidential nomination in 2016 against Donald Trump.
Rates for home loans fell slightly in the latest week. According to Freddie Mac, the 30-year fixed-rate mortgage averaged 4.1%. Rates this year have not followed the typical patterns. They have not been tracking the yield on the 10-year Treasury as closely as they once did, and they've also not been rising as many predicted, and that has helped keep refinancing activity steady.
So if you're thinking of selling your home this spring, you probably know the housing market is hot pretty much everywhere. But when exactly is it the hottest time to list in your neighborhood? Diana Olick has the answers.
The spring housing market is barely underway, but it's already one of the most competitive in years, thanks to low supply and high demand. Sellers are in the driver's seat, but if they want to drive faster sales and even bigger prices, timing is key. Homes listed between May 1st and May 15th sell 9 days faster than an average listing, according to a new survey by Zillow. Not only do they sell faster, but they sell for a $1,500 premium. Why? Because of the competition. Many home buyers who started looking for homes in the early spring will still be searching months later. By May, some may be getting anxious to just get it over with and in turn be more willing to pay a premium to close the deal. That's a national read, but of course all real estate is local and homes in some markets move faster during other weeks. Washington and Atlanta homes move fastest in the first 2 weeks of April. Boston, Phoenix, and Los Angeles homes are hottest during the second 2 weeks of April. For sellers in Detroit, Pittsburgh, and much of Florida, getting the house listed early in March will result in the fastest sale. Researchers at Zillow also said homes listed on Saturdays garner the most views online, but at real estate brokerage Redfin, Thursday is the going theory for getting the most eyeballs. Redfin says more people preparing for weekend open houses start looking on Thursday and are already out shopping by Saturday. For Nightly Business Report, I'm Diana Olick in Washington.
And if you want to read more about the best time to list your home, you can always find Diana's story on our website, nbr.com.
So Thursday's the day.
Thursday's apparently the day. And then you go to the open house on Saturday.
But you've already seen the house.
But you've already seen the house
online.
online.
Got the inside track at that point.
Got it nailed.
There you are.
That does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.
Nightly Business Report has been funded in part by
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.